Right then, good afternoon everyone on Wednesday the 1st of May, and we're going to have a look ahead towards the latest interest rate decision from the Fed this evening. 7 o'clock, the last one I think fell in the couple of weeks where the clocks had changed between the US and the UK. This one's back to 7 o'clock today, as it usually is, with the interest rate decision at 7 and the press conference then obviously following about a half an hour later. No economic projections, no dot plot or any of that over the course of this evening. Just straight interest rate decision statement and then a press conference, and we're going to go through market consensus, things we're looking out for, and then some potential trading opportunities off the back of it. And looking at this, I suppose it could go either way. In my opinion, I don't think it should go either way, but again, I'll speak about that as we go on through the rest of this video. But obviously we got this at 7 o'clock. What I'm going to do is I'm going to start with this interest rate pricing. Now, an interesting thing over the last day or two is, it's not much, but it's 1% chance of a rate hike in this meeting. Right, obviously 99%, you're not getting a rate hike today, you're not getting a rate cut today, rates are going to remain the same. Forward guidance is what we're looking for when it comes to the Fed today. Now, the reason why I think it's interesting is because this wasn't even a thing like a week ago on all of these. But if you look at 1% chance of a hike in May, you look at June, 0.9% of a hike in June, July 0.7, September 0.5, November 0.4, December 0.2. So the market, I'm not saying that the market is now opening up to the possibility of a rate hike, but these boxes have appeared, and there is at least someone that does think there's potential for an interest rate hike. I am someone to think there is potential for it. Whether you get one or not is obviously a completely different question. But through to year end, if you go back to if you just go back to last week, the reason why markets are kind of predicting a bit of a hawkish Fed and why we're predicting a bit of a hawkish Fed today is that if you come back to, let's go to previous week and come back to the PCE figures from last week. Sorry, I scrolled down a bit too far. When you come to Thursday, is low impact on this. So let's get back to the low impact figures. Back to Thursday. Where are we at? So PCE prices, right, and then core PCE prices. Core PCE is the figure that the Fed use, or the Fed's preferred metric of inflation. So core PCE. Now, if we have a look at core PCE, the quarter over quarter figures, that is 3.7% annualized in terms of the core PCE from the year before. So 3.4% on this, or 3.7% should I say, consensus 3.4, but 3.7 on this. You have a look at this and say 3.7% annualized inflation over Q1 for the Fed's preferred metric of inflation. That is not a situation where you cut interest rates. Historically, that is hiking interest rates. If you had said this 5 years ago, maybe before COVID, that 3.7% annualized core PCE, the Fed would be hiking interest rates. The fact that we're even sat here talking about them cutting interest rates when inflation is still where it's at is kind of a bit insane, right? So the risks to cutting interest rates is obviously looking back to the 1970s. We've had a number of Fed officials comment on the 1970s and say that we don't want a repeat of that. When they had high inflation, they hiked interest rates in order to cool it down. It did cool it down, but then they started to cut interest rates too quickly, which led to an acceleration of inflation. Now, over this year so far, we're now 1st of May, inflation has accelerated across the board. Economic data still remains positive, really, apart from these growth figures in Q1, but earnings positive over the last couple of weeks. So you got earnings that are all right. Some of the big companies performing pretty well, and then you get these prices. Core PCE 3.7% annualized inflation on the Fed's preferred metric. Again, it's not really a scenario where cutting interest rates, or even talking about cutting interest rates, is a good idea. Now, inflation may fall off a cliff, through the year end or throughout the summer, but ultimately, you can't really sit and think it might, because ultimately, demand is still pretty good throughout the economy. Economic data still remains positive. The labour market still remains tight. Are contributing factors to inflation. You get the figures out that we had yesterday. This employment cost are like wage inflation figures. Now, the total employment cost grew 1.2%. Right, previous 0.9%, consensus 1%, actual 1.2. Right, employment cost, wages, and then benefits. All of these beating consensus above previous, and positive wage growth, positive wage inflation again contributes to the CPI figures and the PCE figures. So again, that's further inflationary prints yesterday. Right, so that's likely to cause inflation then going forward. You then got other aspects of economic data remains positive. This sort of stuff also remains higher than anticipated. You've also got commodities up at high prices, albeit they've had a bit of a pullback in the recent week or two. But ultimately, commodities are still at high prices. That continues to put upside pressure on inflation. So there's many reasons. There's numerous reasons for inflation to at least remain sticky going forward, and even potential for it to continue moving higher. Now that then brings us on to the Fed and what to expect a little bit later on today, right? Back to this, you've got June. Probabilities for no cut into June is an 89.7% chance. We probably won't get any sort of a cut by then. Then into July, that's what I'm saying, the last number of releases, but you see 75% chance of no cut, again from a month ago, up from 28 up to 75%. You then look at September, right? In September there's a 50% chance of no cut, a 40% chance of a cut. Into November, then it becomes a little bit more equal. Then into December, markets still have a cut pretty much priced by December. So the markets still have a couple of cuts priced, but if inflation doesn't cool down, you can't go and cut interest rates. Even if that core PCE comes down from 3.7 down to 3%, for example, it's still not really a situation where you can go and cut interest rates. Yeah, okay, it'll be back to the 3% target, but to then just get inflation there and then cut, they will need to see it sustainably below. You've had a number of other central banks, like say the Bank of Canada, for example, the ECB, that have waited for inflation to be sustainably below the target range, right, or sustainably within the target range in order to then go and cut interest rates. So Fed in a pretty difficult position, especially with those growth figures massively negative last week, missing consensus by a substantial amount. And then also inflation then rising, not a good situation for the central bank to be in. And then you see, you look at pricing then into it. You've got Aussie, Kiwi, Euro and Sterling then pushing lower. You've got dollar Swiss, dollar CAD, dollar yen, we gotta leave that out, but intervention then is pushing higher. But dollar strength in the lead up to this over the last kind of 24 hours. Equity markets lower in the 24 hours previously. You can see the S&P, the Dow Jones, the Nasdaq and the Russell all lower into the Fed this evening. You then see yields managed to get up through 5% on the 2-year in yesterday's trading, and then rallied higher on the 10-year. They're giving back some of those gains for now, but still kind of grinding higher over the last week or two. Gold down massively heading into the Fed this evening. Again, I mean, these kind of things kind of turning around now, but I wouldn't expect it to have too much action until we get to 7 o'clock a little bit later on. So Bitcoin, bit of risk being taken off the table. So markets, in my opinion, kind of bracing for a hawkish Fed, and there is interest rate cuts still to be priced out if they come and do that, right? So in order for them to talk about interest rate cuts today, I think that would be insanity, right? To say we're still sticking to the script, we're still going to cut interest rates later this year. I think the smart thing to do would be to acknowledge the fact that inflation has risen over the course of this year, and kind of be honest with the fact that it's risen over the course of this year, and kind of stamp their foot down and be like, no, interest rates are going to remain high for as long as it takes, and there is still a potential for a further hike. I mean, I think they should probably acknowledge the fact that there could potentially be another hike, then a hawkish Fed. Now, obviously, there's a lot of people long US dollars over the last while anyway, so it's quite an oversubscribed position. But again, at the end of the day, if I start talking about interest rate hikes, which he will get asked at some point today, whether he mentions it in the statement or not, when it comes around to the press conference, he will get asked about interest rate hikes. His reaction to that question will set the tone for this meeting and probably the coming weeks ahead. So in terms of making an assumption now, the assumption that you would make would be for a hawkish Fed this evening. But that is market consensus, right? We then need to, in order to get a sustained move, you would have to imagine when he gets asked a question about interest rate hikes to confirm that is a possibility. If he then gets asked a question about interest rate hikes and say that we're not looking at that, we're still expecting inflation to come down and we're still looking at cutting interest rates throughout the rest of the year, then obviously you would probably sell US dollars and you would go long stocks, right? So the tradable opportunities then off the back of that were, Personally, I think being long dollars into this isn't a bad idea. In terms of a risk to reward, perspective, being long or short dollars probably isn't a bad idea from risk to reward. I think you got to move either way tonight, but I think being long dollars would be my kind of more probable trade coming into this. And then you got to ask yourself, where do you get long dollars against, right? The Australian Central Bank, the RBA, there is no cuts priced in for this year for the RBA, right? Inflation is still far too high. They still have a lot more progress to do in order to get inflation down to then cut interest rates. So if you're going long US dollars, it removes the Australian dollar off the table. The Kiwi dollar, in New Zealand, inflation is still too high. They're still not at the stage of cutting interest rates. Therefore, I think the New Zealand dollar kind of gets taken away as well. The flip side to that is the Australian dollar and the New Zealand dollar are quite risk-sensitive currencies. They move in line with risk sentiment, and if a hawkish Fed causes stocks to sell off, that should get the Aussie and Kiwi lower with it. So maybe from a short-term trade perspective, your Aussie and your Kiwi might be attractive to the downside, but ultimately to hold it past this evening, you'd probably want to be positioned in a different pair, right? Now, Euro and Sterling then come into focus. Euro, right? The ECB are going to cut interest rates in June, or that's certainly what we're expecting. Now, if the Fed then come out hawkish and say we may not get a cut this year and there's potential that we hike, that then puts the ECB and the Fed on a different path in terms of monetary policy. So we'll call what we call monetary policy divergence, right? One central bank that's cutting, one central bank that's not cutting and talking about potential hikes should be easy sustained downside in euro dollar. Even if that position is oversubscribed and the dollar is a bit overbought, again, monetary policy divergence should get this currency pair to move lower. Ultimately, we're looking at futures pricing, saying that, and futures pricing is not total market volume, so should be downside for euro dollar to come off the back of that. Rate cut expectations for the UK have been brought forward. Again, that would not quite just yet, but it will probably put the Bank of England and the Fed on a different paths of monetary policy a little bit later on in the year. So I think sterling's not a bad bet to the downside. It's naturally a more volatile pair than euro dollar and is a bit risk sensitive at times as well, with equity markets then pushing lower, you'd imagine. All right, dollar Swiss, the Swiss National Bank are the first central bank to cut interest rates. I think dollar Swiss longs would then make sense. If euro dollar goes short, then dollar Swiss longs are even better in that respect. Dollar CAD, the Canadian Central Bank suggested that they are likely to see interest rate cuts, or there's potential, should I say, for interest rate cuts at their June meeting. There's a bit kind of 50-50 pricing as to whether we do or do not get a cut in June, but certainly by July. And then you had weak GDP figures yesterday out of Canada, so I think dollar CAD longs are quite attractive. Dollar yen I'd probably stay away from. So that gives you euro dollar, cable, dollar Swiss and dollar CAD. Euro dollar and dollar CAD for me would be my two options, or I say will be my two options a little bit later on. Dollar CAD, again, you look at oil then trending lower, puts a bit of upside pressure on dollar CAD. Euro dollar shorts, dollar CAD longs, I don't think are a bad bet into the Fed this evening, right? That then will come with some downside in equities. Being downside in equities is being short equities is not the easiest trade at the best of times. So short equities is an option. I think long dollars is probably slightly easier of a trade. Gold is an interesting one. Gold will be such a heavily net long asset from so many people that higher interest rates higher for longer is negative for gold, and then people will sell gold, and also you've got a lot of people long who will look to probably have to exit some long positions. So gold shorts as well, pretty attractive. Euro dollar shorts, dollar CAD longs, gold shorts off the back of a hawkish Fed tonight would be my will be my bets if that does go and play out. On the flip side, if they decide to kind of bottle it and Jerome Powell keeps his head in the sand a bit, and kind of doesn't really live in reality, in my opinion, and come out and say no, inflation's under control. We have reasons to believe that inflation will continue to come down. We're not looking at hiking interest rates. Cuts are still on the card. These kinds of comments, then it's likely to be the opposite way, and then your trade ideas are what? Right? If you're looking for US dollar weakness off the back of a bit of it's kind of like not talking about hikes, backtracking on hikes and still mentioning the cuts are on the table through to year end. That would be a situation where we're short dollars, and then for the reasons that I have suggested, Aussie dollar and Kiwi dollar, definitely Aussie dollar, you would imagine, would probably be a good bet to the top side. Any weakness in the US dollar will probably likely be jumped on by maybe the Ministry of Finance in Japan. Maybe that might be a decent bet to the downside with this intervention from the other day. They're clearly trying to prop up the price of the Japanese yen. Any sort of sustained move lower in dollar yen potentially might be jumped on. So Aussie dollar long, Aussie against the dollar long, and dollar yen short, probably my two bets. I keep saying probably, but will be my two bets. If you get a dovish Fed, equity markets then probably look attractive to the upside. Backtracking on rate hikes, confirming the fact that we will see cuts, does make stocks a good buy at these prices. You're 6-7% off the highs. Not a bad bet for long some stocks, and then you can probably hold that for at least till NFP on Friday. So more likely scenario, in my opinion, is a hawkish Fed, short euro dollar, long dollar CAD, and short gold. Into that are the options. Out of a dovish Fed, which is the less probable scenario, you will have people closing dollar longs, so that then in itself should cause a decent move. Short US dollars, I think Aussie and dollar yen are the ones to play, and then some upside in equities. Gold will probably then rally as well, gives you a bit of a dip to buy into on gold. So that's what we're looking out for today. Comments on interest rate hikes. He will get asked that question at some point today. That is the tradable opportunity, right? Whether he goes and comments on something like that in a statement, we can't really predict that ahead of time, but that is for me the key bit of information out of today, right? But he talks in a statement, then we can have a look at that. But in his press conference, he will get asked about interest rate hikes. His answer to that, I think, sets the tone for tonight.